All right, Goldman Sachs is sounding a little more cautious on the hot AI trade, and a new note out today, in large part citing valuations. This is the investment bank gears up for the start of its big annual Communicopia Tech and Media Conference next week. I'll be out. I'm so psyched. Goldman Sachs' Sheridan is here with me now. Eric, always nice to get some time with you. I want to go into this AI note your team's put out, but off a jobs report. Let's just start there. Off a disappointing jobs report like this, how does it impact your thinking on some of the large cap tech names that you cover, whether it's a Meta, Alphabet, you name it?
Well, I think there's a couple things around the labor market that impact the technology field. Number one, most of the companies I cover continue to be balancing legacy operating cost efficiencies with the need to reinvest in the forward AI curve over the next 3 to 5 years. So you have sort of a push and pull, the way these companies talk about legacy costs and forward investments that can have an impact on employment numbers. I mean, most of the companies I cover have had low to no net employee growth over the last 6 to 8 quarters as they've realigned their organizations for where they're going over the longer term with respect to AI. It's sort of pulling OpEx out of the business model with an eye towards putting that capital back into capital expenditures that go toward the infrastructure layer.
I really enjoyed your team's AI note this morning. I believe it was by Ryan Hammond and a very large team doing work on this. Sounding the alarm a bit on AI stock valuations. And I'm glad your team brought this up because we saw large sell-offs this week at Salesforce, Figma, C3I. After earnings, they were okay, but they didn't blow anybody away. Conference calls were okay. Outlooks were so-so. Should investors be concerned about AI valuations at these levels, and why so?
Well, you and I have talked about this before, Brian, but this trade is very nonlinear and volatile in nature. So, when you go from the advent of the idea, when ChatGPT came to the forefront in November 22, to building out the infrastructure layer, to eventually having to build out the application layer of AI, it is not a straight line. And I think what we're seeing right now with AI is that we are clearly moving from a infrastructure layer investment theme towards an application theme. And we are seeing differences between how the applications of AI are deployed by consumers and by enterprises. Enterprises have to operate within strict budget requirements, and you also run into some friction on the employee side with respect to how they use AI in their own individual workflows. We see when you look at consumer AI that people are much more likely to adopt AI in their consumer computing habits than their enterprise computing habits because they see less potential for that to impact their own earnings power, to be frank. And I think at the end of the day, you're seeing very different skews of how AI is being adopted between consumers and enterprises.
Eric, I'm not sure if you saw this, that the tech meeting dinner last night, the President Trump, it was just the optics were amazing to me. You have Mark Zuckerberg over at Meta sitting next to President Trump and Bill Gates on the other side. It's fascinating theater if you're in media and you happen to cover stocks. Nonetheless, you cover Meta. You've been bullish on Meta shares. Zuckerberg said last night at dinner they plan to invest $600 billion in AI-related CapEx in the U.S., I believe, through 2028. Is that too much in your view?
Well, it is a greater dollar amount than we have in our financial projections today. Now, the nuance in that is you don't know from the outside looking in how much of these investments are going to be made by Meta themselves and how many of them may be made by third parties, such as private equity firms and private credit and data center companies away from the profit and loss statement of Meta. So I think there's a lot of large numbers being thrown out, a couple of $1 trillion before the end of the decade, hundreds of billions of dollars by individual companies. I think the devil is somewhat in the details of how much of this is actually going to end up on the financials of any one given company, as opposed to elements of private equity, JVs, partnerships. I think there's a lot of that's still to be sorted out.
Is the growth in Meta's businesses, Eric, whether it's Facebook, Instagram, or even WhatsApp, are they supportive of a $600 billion investment in AI CapEx? I'm trying to figure out what's the next growth catalyst for each of those platforms.
Yeah, well, there's a couple of growth platforms at Meta that we would highlight. The deployment of AI into advertising systems is an area where you can actually today see real benefits of AI driving faster revenue growth. So we wrote a note a couple of months ago talking about how AI can disrupt existing advertising profit pools and highlighted Meta along with Alphabet and Pinterest and AppLovin as companies that could benefit from that broader secular theme, and identified hundreds of billions of dollars of existing industry profit pools that could move towards the digital advertising landscape. Last quarter alone, deploying more AI into their content recommendation engine resulted in a mid-single-digit increase sequentially in engagement, meaning folks like you and I used Instagram more because Instagram's content recommendation engine was being better run through a mixture of AI and machine learning. And there are elements of that we think remain underappreciated that could sustain high teens or 20% growth for longer.
Lastly, Eric, Google's antitrust case effectively over. Is it off to the races for that stock? Because as you and I know, that stock has been trading at a discount to the broader S&P 500 for some time, in large part because of this case.
Yeah, so in a note the other day coming out of that ruling, what we articulated is that you could see Alphabet make a move now towards a market multiple. It does trade around 3 to 4 points below a market multiple today on 2026 and 2027 earnings, depending on how far out in terms of operating estimates you want to use for your valuation metrics. That could push us towards an upside node. We've articulated an upside node in the stock closer to $300 a share against our price target, which is roughly where it's trading today. And as people get more comfortable with the mixture of assets inside Alphabet, what's been interesting about this ruling, Brian, is that the ruling acted as an overhang on the multiple. But if you actually go out and talk to investors like I do every day, most of them want to own Google Cloud, YouTube, and Waymo as exposure to those businesses, but the overhang was on search. With the overhang lifting around search, you do wonder if you end up with a full re-rating of this asset portfolio, as we've talked about in some of our prior notes.
All right, we'll let you go. I know you got a big week, probably a big weekend of prep ahead of Communacopia. Looking forward to seeing you there. Looking forward to being at that conference. Thanks, Eric. Appreciate it.
Take care, Brian. See you out there.